You are not going to see it now, but during the final stage of the class, you're going to see it's going to help you. But apart from that, it was great. Everybody did well. You guys did great. So that's what I can say. So any questions before we continue chapter 3? Any questions before we continue chapter 3? The floor is open. If
Yes,
anyone,
Professor.
yes,
All
go
right.
ahead.
I think I probably have the same question as Amina did. Question two was the only question I got wrong, and in the notes it didn't say anything about mortization. I just want to clarify what's the proper
No, no, no.
you
I
know.
will look into it. I'm going to look into it. That's a question too, right? Of the multiple choice question, right? You
Yes.
talk about it. Yeah, yeah. Question two. No, no. I'll look into it. Don't worry about it. Okay. I'm just sometimes
All
maybe
right.
it can be wrong. I will just collect it once I see the is mistake. I'm just going to collect it. Okay.
Okay. Thank you so
So
much.
yeah, yeah. Don't worry about that. Don't worry about that. So in the let me ask you in the note, what does it say about the good about that? What does it say about the note?
It doesn't mention anything about amortization, but the first answer was exactly as your notes was written. 'Cause I did go through your notes while I was taking tests. I'm not gonna lie.
Okay, of course, it's online this thing, so it's allowed to do that. As a matter of
Yeah.
fact, let me look at the question two right now. Can you guys give me 1 second? Let me look at the question two, please, so that I can fix it right away. Let me look at the question number two, the examination. Okay, exam one. Question number two. Set up the question. Question number two. Okay, so let me see the question. So the objective of this in non-control is to improve the relevance of the facility to eliminate the amortization to improve. Yeah, so the answer is not to eliminate the amortization of the good one. That's not the answer. Was that the answer you guys saw?
Say that one more time.
Yeah, was that you guys are talking about this? Let me see if I can share this one with you. The test is finished, so I can share this one. So give me 1 second. Yeah. You're talking about this one, right? This is question number two. Is this one we're talking about?
Yes.
Yeah, so it said the objective of this one are as follows. One, to improve the relevancy of the oh, okay, I get it. The answer should be this one.
Yeah.
Yeah, okay. Don't worry. Once I fix it, it's going to save the work. Save it. So you guys are going to get a credit for that. Once I save it, it's going to collect itself. So thank you. Because the rest, everything was okay. Yeah. So if you check your answer now, you're going to get it right. If you get it wrong, it's going to mark it right for you. So don't worry about it.
Excuse me?
Yes.
The
Yeah, it's Kiana.
Yeah, King, go ahead.
Yeah, that's what I was talking about last time because the 20th question it said optional, and then when I submitted my quiz it said 96 out of 110. So I thought it was counted against me.
No, remember I addressed that one on a Monday when you asked the question. I
Yeah, that's what I
addressed it.
was talking about because it said because of what you showed just now.
No, no, that one is a multiple choice question. It's not the problem. The one I showed was the multiple choice question.
Okay.
It's not a problem. No, it's not the bonus question. No, it's not that one. This one is a multiple choice question. And
Okay.
like remember the Monday I explained to you that, for example, if your grade is around 95 over 110, it's not over 110, it's over 100. In my final calculation, it's going to be based on 100, not on 110. 110 is just an extra credit you are going to get, especially if you lose some of the homework. You don't get everything in the homework. It's going to help you out, but it has nothing to do. You get a 96 is out of 100, not out. So for example, if question number 2, you get it wrong, but now the answer is a word to eliminate the, which is not to eliminate, then your grade is going to go up by 2. So you're going to be 98.
Okay.
Yeah. Okay, so let's,
Professor, so the grade
yes.
already changed inside the system, or we have to wait?
No, it's going to change right away inside the system. It should change.
Okay.
Yeah, I
I
think,
checked
yeah,
it didn't, so I just want to
it didn't, right?
know.
Okay, hold on. Uh,
The right because the right answer, according to your notes, was to improve the relevance one, not to eliminate.
so
Yes. Yeah, he
so
corrected it.
yeah, I collected it. No, I'm going to fix it. It should automatically generate the distance. If not, don't worry. I'm just going to do it for you. Okay?
Thank you.
You're welcome. Okay, so let's move on. Those who were, I'll just go a little back on the, especially some of you missed the class on that. So chapter 3 is actually based on one of the important part of this chapter is the elimination process, that we have to eliminate some of the account. Give me 1 second here. I thought I have the notes shared here. Give me 1 second, the lecture note. I'm coming just a minute. So on chapter 3, we talk about the consolidated financial statement at the initial purchases. When the company acquired the business initially, the first year, they had to prepare the consolidated balance sheet. And before you prepare the consolidated balance sheet, you have to do something called the elimination process, meaning that you have to eliminate some of the intercompany transactions. So what we did is that it gave the summary of the how to do the elimination here. It gave us, we talk about a summary here. For example, let's go back a little bit because of those who were not here. So consolidated financial statement, if the company acquire the asset of the company or the stock of the company. So for example, A company is acquiring the B because the B control the A control the B company. They have to prepare the consolidated balance sheet. So the day of the acquisition, company A acquired the common stock of the B. So we debit the word investment. Investment is the consideration you are giving. You are buying, you are giving them the cash of the word you are investing your money in the company. Then you carry the word consideration, meaning that the common stocks that you are giving in order to get the company. And one of the things I mentioned is that because if you want to prepare the consolidated balance sheet here, you have to be able to do this one, which is very important, working paper. The working paper is necessary in order for you to prepare the consolidated account. And the working paper, what you are doing is what you are going to eliminate your investment here against the common stock or the equity of the company, against the equity of the company that you are buying, equity of the company that you are buying. That is what we did most in the world on Monday. So we said based on that, we give an example here that, for example, let's assume that on January 1, P company acquired 100%. 100% means that there's no non-control. Remember on Monday, we talk about the controlling parent company and non-controlling company. And we mentioned that when it comes to the parent company, we always like we have the company, give me 1 second. We have the company like a P company. So this is a subsidiary company. So this is a S company is a subsidiary company. If P company, this company can belong to two people. One is the parent company. Parent company is the one who control the subsidiary company. If the parent company buy 100% of the company, it means that there's no non-control. But if they buy less than 90%, there's something called a what? Non-controlling interest. Non-controlling interest. It simply means they're part of the company that belong to outsiders. Before, on chapter 2, when we went to the changes, it was used to be called minority interest. Now it's called a what? Non-controlling interest. Non-controlling interest only comes in if the parent company purchase less than 100% of the company. If they purchase less than 100% of the company, we create non-controlling interest. So if you look at this one we are doing here, there's no non-controlling interest because the company purchased 100% of the company. So in exchange, they give them the word of they issue 40,000 shares of 10% of the parent company shares, which is now in the market of the word $17.50. P company also incurred 20,000 for extra expenses and also $10,000 for the finders, like you guys did on the test. I think question number 3 in the test, you have to do something like that. So this is where the P and S stand here. So how much they invested? The company said, 1, we are going to debit the investment here. Investment is 700,000. Why 700,000? Because we are not paying them cash. We are giving them 40,000 of our shares, which has the market value of $17.50. So we debit our investment here, initial journal entry. We are giving them 40,000 shares. The par value of our share is $10. So we are creating extra capital for our company, which is our 700,000 here that we are creating as an extra money that is coming into the company. Why? Because the market value of our share is up. Now, they also paid, we know they paid this one, we covered this one, so I'm not going back into how we get this one. Now, example 2 is saying that what if, assuming that the book value of the asset liability represent the fair value of the S company, which means that in terms of the liability and also the assets, everything represent the book value. And the fair value of the net asset is 500,000. Price paid equal to the fair value. So you are paying $500. Why? Because the fair value is 500. Therefore, your initial journal entry will be debit your investment in the subsidiary company and credit your cash. Now, what I said on Monday, I'm saying it again. The first thing when you are doing the working paper, here, is to eliminate this investment. Why are we eliminating it? Because it's intercompany transaction. The company that you are buying, you bought a company, it belongs to you. So your investment this investment here should be eliminated against the equity of the company, equity of the S company. So if you look at the equity of the company, they have the common stock. They have the retained earnings. So in order for you to eliminate this investment, you have to debit the common stock here. Amount of the 200,000. I'm putting 200. Retained earnings of the S company, which is the 300,000. Then credit your investment in in S company, your investment of the 500 here. So in your consolidated balance sheet, this one will be eliminated. You are not going to record. So in your consolidated, you are going to record only common stock of the P company, other contributed capital of the P company, and the retained earnings of the P company. Now, so So prepare the consolidated working paper, eliminating entry, and this is what you have to know here. On chapter 4, I'm going to add more. We are going to add more to it, more elimination process that we have to do. But on this chapter 3, intercompany account that should be eliminated is number 1. Eliminate the investments against the equity of the company. That's the one I just completed. 2, if there's any intercompany receivable, eliminate that receivable against the payable. And I did give an example on Monday, like let's assume that we have the 2 companies here. We have the parent company and we have the S company. If the parent company sold merchandise to the S company, we are going to, on chapter 5, we are going to look at the name. We call that one downstream, which means that in the books of the P is selling the merchandise. So P is going to debit accounts receivable and carry the sales, which we all know. So let's assume that it's $100 here, $100 here. S is receiving the merchandise. So S is going to debit what? Purchases here. And S is going to carry the what? Account payable. $100 here, $100 here. Because it's intercompany transactions, we have to eliminate it. So we are going to eliminate the accounts receivable here against the account payable in the books of this. So in your working papers here, you are going to debit account payable because it was credited by S, by the subsidiary company, 100, and we are going to credit the account receivable here as 100. So you have eliminated the account receivable against the account payable. And if you guys remember, I asked a question. Somebody is going to ask, Professor, what happened to the sales and the purchases? When we go to chapter 4, we are going to eliminate this one. We are going to eliminate these sales against the purchases or cost of goods sold. In chapter 4, we are going to do that because it's intercompany transaction. Therefore, you have to eliminate it. Another example here, if there is any intercompany advance, meaning that if A or parent company gives some money in advance, cash in advance to subsidiary company S, we have to eliminate it. If another example, if this in the intercompany revenue should be eliminated against the expenses. Why? Let's assume that the advance payment or the loan, let's assume that P give up a loan. P give up a loan to the subsidiary company. And the loan amount, let's assume the loan here, the loan amount that they give is somewhere 200,000 here. And the interest on the loan, is maybe 10% annually, which means that every year P will receive interest from the S company. You guys did the intermediate accounting. So we know that when P received the interest, P is going to debit cash. I'm just making it maybe 2,000, right? And the P is going to carry the word interest revenue. Very good. Interest revenue. S is given. So what the S is going to do? S is going to debit the interest expenses, right? And carry the cash. We have to eliminate this here, revenue against the expenses. That's what it's saying here. We have to eliminate it. Therefore, we are going to debit the interest revenue and carry the interest expenses because it's intercompany transaction. Any intercompany transaction should be eliminated before we prepare the consolidated balance sheet income statement. Any question? I'm just revising what we did this thing. So any questions? Because this chapter is very important. It has something to do with chapter 4. Any questions so far? Any? The floor is open. Any questions, or can we continue? Okay.
Yes.
Then you here to say eliminate the revenue dividend. You guys did, you know, the dividend. Well, so let's assume it that remember, because we are investing in the company, if P company receive dividend, right, from S company, P company is going to debit the what? The cash, and get the what? Dividend income. Get the dividend income, because the income or the dividend revenue or income is the same thing. S is the one giving the revenue. S is the one giving the what? The revenue. So it's going to debit the what? Dividend declared. Dividend declared here will be debit, and it's going to carry the what? Cash. On chapter 6, we are going to eliminate chapter 5. We are going to eliminate this dividend received against the what? The dividend declared. Therefore, we are going to debit dividend revenue and carry the word dividend declared to eliminate the intercompany transaction. So from now on, anything all about the advanced accounting is about the elimination process and method of the intercompany transaction and the preparation of the word consolidated word balance sheet. So we talk about first you have to eliminate your investment, and we just did. One of the things I mentioned on Monday in the process that this one is very important. Implied value and the book value. So what's the difference between the implied value and the book value is with the term, whether there is a something called the word non-controlling interest or even the goodwill. So when we talk about IV, implied value here, this is the what? The amount that the parent company are willing to pay, or the amount, the investment, or the amount they are willing to what? To, or the value of the what? The company. Now, the book value, as we all know, is the what? Is the value of the company. So if the company is maybe 2 million here, 200,000 here, and you pay the IV here, let's assume that the parent company pay $80 here, 80,000 here. Then the question is, how much the percentage? Because implied value formula is equal to the price paid, the amount the parent company is paying, divided by the percentage of what the parent company, how much the percentage that the parent company have. Once you get the value here, this value here will be divided into two. One will go to the parent company, one will go to what? Non-controlling interest. All the implied value will go to the parent company if the parent company own 100% of the company. If they own 100% of the company, then that will go to the what? Imply the book value. So we did example here. If you remember, that we are going to use the case one. Implied value, if the implied value is equal to the book value, and it can mean that the company will be acquired 100% or less than 100%, which means that there's no goodwill. That's all. There's no goodwill. The implied value equal to the what? To the book value. Case number two, if the implied value of the subsidiary company exceed the book value of the subsidiary equity, it simply means that they can buy 100% or less than 100%. And we did some example here that let's assume a case whereby in this case, your implied value equal to the what? To the 100%. The company, parent company is purchasing 100%. So we make an assumption that let's assume that P company acquired all the outstanding stocks of 10,000 of S company, and they pay 160,000. The day of your investment, you debit the what? Investment, you carry the what? The cash. The first thing you have to calculate, what is the implied value? We know implied value is called the what? The price. You are paying 160,000 divided by the what? 100%. So that gives you the what? the same 160. That is why you see here. If you divide this one, 2, you get the same. So implied value equal to the book value. There's no difference, meaning that we didn't create any difference, like maybe the goodwill or not. But one of the things, the first thing that you have to eliminate your investment here against the equity. So you can see the 160 that you are paying here, your investment here is equal to the equity of the what? The subsidiary, equal to the equity of the subsidiary, which consists of the what? A common stock of 100,000, other contributed capital of the what? The 20,000, and retained earnings of the what? The 40,000. So step 1 on the elimination, before you prepare the balance sheet, you have to eliminate the equity of the what? The subsidiary company against your investment here. So that in the balance sheet, we are just going to show only the common stock of the parent company, other contributed capital of the parent company, and retained earnings of the parent company, because you have eliminated the what? The investment against the equity, which is the first thing that is on the table here. If you look at the table here, that's the first thing. You have to eliminate your investment against the what? Equity of the subsidiary company. So after you do the elimination, so 2, the work paper to consolidate the balance sheet for P and S were as follow. This is before, right? If you look at it, this is before. We have not done the elimination process. We have the cash to be 80,000. You add their other asset. You add their P and E. You add the land. Your investment is here. Now, what will be the what? Investment after they have the what? Liability? Everything is here. So adjustment and elimination entries are made on the working paper. You have to now make adjustment entry. So 1, eliminate the investment. This is a working paper only. So we debit the what? 100,000. Why? Because the common stock of S here is 100,000. Other contributed capital 20. Retained earnings against the investment here. In other words, this, as soon as you do this investment here is now eliminated. This one is gone. It's gone. And all this here is also gone. So what is that? This one is going to stay. 80, 380, PPE, land investment is gone. So if you add this here, can somebody quickly add this for us, please? 80,000 plus 380 plus 120. How much do we have? 80 plus 380 plus 320 plus 120. Please, if somebody
900.
can. 300?
900?
900. So
1,000.
your total assets 900. Remember, you have eliminated this $100 here. 100,000 of common stock. So now the common stock here is a what? 400,000. You have eliminated the 20,000. So this is no longer, is now 80,000. Can start adding it for me, please. You have eliminated retained earnings. So this is out. It's now 200,000 here. So you are going to add 220,000 plus 400,000 plus 80,000 plus 200,000. How much do you have?
It's 900,000.
900,000. So still your equation, your consolidated is balancing because you have eliminated the word intercompany transactions. You have eliminated the intercompany transactions here. Another example too. What if you invested 80,000 here? You are acquire all the outstanding, you pay 80,000, and there's the balance sheet before the word the consolidated. Simple, meaning that this 80,000 that you invested here should be eliminated against this 3 here. You see, eliminated against this 3 here before you prepare the consolidated balance sheet. So if you look at it, we eliminated against our investment. Now, if we want to prepare, let's prepare our balance sheet now and see what is going to happen here. So we know that this one here, nothing. We didn't eliminate anything here, right? So the balance here is going to be what? The 40,000. Other asset here, if I'm not mistaken, is going to be 190. Somebody should start adding the numbers for us. Plant and equipment, 160,000. Land, 60,000. Investment here, we are going to eliminate this investment here. So it's going to be nothing. It's going to be zero here. So how much the total asset here? How much the asset that we have here? How much the asset, please? Oh, we have to eliminate it, sorry, here. So we are going to put here 80,000, but we have to eliminate it. So how much is the total here? Let me see.
450.
550?
450.
450, thank you. 450 here. So which means that our assets should be equal, right? So let's do our liability. So liability here is the same account. It's 110. We are not eliminating that. So 110,000. We have the common stock. We are going to eliminate this one. So we are going to debit 50,000 here. So the common stock here is going to be what? 200,000. But we have eliminated the what? The subsidiary company common stock. We are eliminating the other contributed 10,000. So this one is going to be 40,000. Here we are eliminating 20,000 will be eliminated. This one is what? 100,000. So let's do the calculation and let's see. This side, the total on the elimination column here is going to be 80,000. The credit side here is also going to be 80,000. And what about the total here? It should be 450. Is it 450? No, I think so, right? This is 3, 4, yeah, 450. So you have eliminated the word intercompany transaction by eliminating the investment against the word the equity. Now, second scenario here, what if you paid? You see, you acquired 90%, which means that you didn't acquire 100%. Therefore, it's going to create the word non-controlling interest. So first, you have to calculate the what? You debit this one, you credit this one. Before you do the elimination process, you have to calculate the what? Do the working papers here by calculating the what? The implied value here, which is equal to 144,000 divided by 0.9. So how much is the value, entire value of the company now? How much the entire value of the company? Because we acquired 90%.
I have a question. Why we do
Yes.
like eliminated the investment? It doesn't go for cash flows?
No,
No?
because that's why you are eliminating it, so that it will not appear in the
Okay.
consolidated balance sheet.
So why we do that?
Because it's like, remember, business combination is you are presenting two companies as one company, right? Let me give a typical example. If you have your wife, you have your husband, right? Two of you are seen as one, right? Your cash is the whole family cash. Your land is the whole family land. So if you borrow money from your husband, are you actually borrowing money? It's your money. For two of you, your money is your money, right? So we have to eliminate any transaction between two of you.
Oh, it's like we have a already company, but we are now combining it. So it's like
Yes,
there's a paperwork. Okay.
that's what we are. So we are doing the paperwork to eliminate all these intercompany internal transactions so that everything that will appear in the income statement, in the balance sheet, will be all external transactions, not the internal transactions.
So it's basically is nothing going from our side. We're just combining.
Combining together, right? So that's what we are. So if we are combining together, then any investment should be eliminated against the equity, because we are buying your equity, right? We own the company, so we have to eliminate it. So once you get a less than 90, it means that part of the company belongs to outsiders. Therefore, how much of the company that belong to outsiders is 10%. 10% belong to the outsider. So the question is, how much the value of the 10%? We know that the value of the 90% is what you paid here. So first, we have to look at the entire value of the company, which is known as the word implied value, which is simply means that take the price that parent company paid divided by the percentage that the parent company have. So in this case, I don't know, 144 divided by 90%, how much? How much the value of the company?
160,000.
160. So it means that the whole company, the value of the whole company, the subsidiary company is what? 160. Out of this 160, 90% is owned by the parent company, which is a what? 144,000. 10% here is owned to outsiders, non-controlling, which will be equal to what? If I'm not mistaken, 16,000, right? 16,000 amount, which means the 160,000 here, 16,000 belong to the what? To the outsiders. Belong to the what? To the outsiders. So in our working paper, we have to state how much of the company belong to the outsiders. So if you look at here, you see here, 144, 16,000 here before we prepare the consolidated account. So we are eliminating common stock step. We are eliminating the common stock, 100,000, other contributed, 20,000. Everything here had to be, all the equity of the S company here should be eliminated. We eliminated by debiting the what? The common stock, the other contributed capital against the what? The equity of the company, which is this one here. So this is gone. Now, non-controlling interest here is created because the company, we acquire only 90% of the company. So this 16,000 is equal to the implied value that we did with the 160,000 here divided by the what? 0.10. That gives you the what? 16,000, which then your debit must equal to, you have eliminated your investment against the what? The equity of the what? The company. Equity of the what? The company. Now, the same thing here, what if? And because of that, let's see, we're doing, I know we did this one here also, because why? If you look at this one, it said, assuming that is 80%. So if you pay 80% to get a company first, what is the implied value here? Which is the what? The 148,000 divided by the percentage of the parent company, 0.80, right? And I think this gives you the what? 185,000, right?
Yes. Okay.
You see, out of this and this one, parent company here have 80%, which is equal to the what? 148. The rest of this, which is the 20% here, belong to the non-controlling interest, which is equal to the what? I don't know how much is the 20% of this one, but if I'm not mistaken, I think it's going to be 20, 30, 32. I don't know, I'm just guessing. It should be more than that. It's 185, this is 148. I don't know. How much is this, please? Can somebody do for us? How much the 20% of 185,000? How much the 80% of 185,000?
37,000.
So it means that 37,000 here belong to the what? To the outsiders. Now we look at the what? The value. So if you look at it, I'm going back, the journal entry. First, we did the journal. So in your elimination here, first one elimination, you eliminate the common stock. Now, there's a difference here. Why? Because your credit side here is what greater than the what your debit side. So we say difference between the implied value and the book value. Then the question is, they have to tell us where should we allocate the difference to. As a matter of fact, on chapter 5, they are going to tell us we are going to allocate them to the asset and the liabilities of the company. But here they have to tell us if there's any difference between the book value and the implied value, how should be allocated. And it was stated here. The working paper, they said if there's any difference between them allocated to the land, said we assume that the entire difference is attributed to the land. So if there's any difference between your debit and credit, put it on the what? The land. So working paper 2, the land will now go up. So 1, we are eliminating. 2, we are adding the what? 25 to the land, because that's what is said here. If there's any difference, allocate it to the what? To the land. Allocate it to the what? To the land. And I'll stop here. Then go back to our class exercise that we were doing. I know we started, I don't think we finished. I think only one or so. So if you look at what we have here, we did this exercise here. We didn't finish the second one. So we did this one here. With that first one, it said the A, you invested 175,500. So with debit investment, we carried the what? The cash, part A. Part B said now eliminate. So we have to do the part A. What is the elimination? We eliminate the common stock of 80,000 is debit, because it's the common stock, debit the what? The 80,000 is debit here. We credit, give me one, if I can do everything here like that. Okay, good. So we eliminated the other contributor capital is debit. Retained earnings is debit. We credit the investment. So this one is the investment here. So we credit 175,500 here. Then we saw that the credit side here is more than the debit side here by 28,000. And we're told here, any difference between the book value of the net asset and the value implied by the purchases price is related to the what? Property, plant, and equipment, except for case number C. In case C, assuming that book value and the fair value are the what? The same, which means there's not going to be any difference. Part B, here we purchase only, we have only 90%. So we have to the first thing is that what is the what? Implied value, right? So we debit our investment, we carry the what? The common, the cash here. We have to eliminate the what? The common stock, 85,000. Common stock is part B. The common stock is 95. So this one is 95. I don't know why we put a 90. The other contributed capital here. Other contributed capital here is 30. Oh, I just paste it to make the difference, but we're not able to do it. We don't know about this one for now. So this one, you leave it for now. Then we credit the retained earnings, because it's a negative of the 14,500. We invested the 116. Then we have to calculate the imply the non-controlling interest. And the non-controlling interest, we calculated it by doing the following. I'll put it inside here. What we did is that we took the value, which is we paid 116,000, divided by the percentage, which is 0.90. then multiply by what? 10%. We have the 10% in the company. So multiply by 10%, that give us the what? 12,898. Therefore, when you add the credit and you add the debit here, the difference is the what? 10,889. C, we do the same thing. Let's do the C together. C, we have the word. You can investment. The first journal entry will be your investment. That you are so your investment in S company, you invested 79,500. So your cash here is 79,500 here. Two, you have to now do the word eliminate. So we are going to debit the word the common stock of S company, which based on this is 90,000. We have the word the other contributed capital here. So give me 1 second. Other contributed capital of S company, which is amounted to what? 20,000. Then we have the so we don't know. I will leave this one for now. We have the what? Retained earnings, because it's a credit balance. So retained earnings in S company, which amounted to 2,000. The parent company have 80%. So that's the what? The investment. We are eliminating our investment in the what? In S company, which is 79,500. We have non-controlling interest because we have less than 100%. Non-controlling interest, which into bracket 79,500 divided by the 0.80 times 20%. Times 20%, 0.20. So how much? Go to the calculator, please. How much do we have here? Those with the calculator, if you can help me, how much do we have?
Says 19,875.
19,000.
875.
875. 19,875. 19,875 here. 19,875. But this is what? So let's see the value here. How much I want to do this one here. Remember, let's first look at the what. I will leave this one for now. I'm going to add something, but I'm going to leave this one now. For now, let's look at the what. The value of the company here, right? The book value. What is the book value? Let's look at the book value of this company here. Right? The book value of this company consists of the what? The 90,000 plus the what? The 20,000 minus the what? The 2,000 here. So how much the book value here, please? I want somebody to give us the book value here. How much the book value?
108,000.
108,000, right? 108,000 is the what? The book value. But how much did the company paid? How much did we pay for how much did we invest it? In other words, how much did we pay for this company? He said we pay 100 and what? We paid not 100, we pay, give me, I want to do this one. Make it right. Okay, we paid what? 79,000. The value of the amount that we paid is what? 79,000. Or let's assume that the imply, can you divide this one and let's see here the implied value. Let's look at the implied value here. Implied value here, which is equals to 79,500 divided by 0.80. How much do we have?
It's 99,375.
99,000.
375.
375. So, oh, sorry, 99,375, like this, right? So this is the value of the company. This is how much is the entire value you are paying for. Therefore, you pay, remember chapter 2, gain on the what? You gain here. There's a gain. So how much is the gain here? Gain on the what? On purchase or on the business acquisition. How much is the gain?
It is 8,625.
Very good. You gain 8,675, like this?
It's 25.
25. So 8,625. And I want you to pay attention here. This is how much you gain. Why is this? Because it's simple. Your implied value, the amount that implied value is less than the book value. So you are paying less amount. Therefore, this is the gain. This gain here, we are going to share this gain among. So the gain here should be shared. The gain of 8,625 will be shared among the parent company and the what? Non-controlling. The parent company is going to get 80% of that. Non-controlling is going to 20% of that. So how much is the 20% here? So I'm going to do the math here, but I just want to explain what is happening here. So in other words, we are going to divide the gain here. So share of the what? The gain. Parent company here. So let's do the parent company are going to get a what? 0.80 times 8,625. So how much are they getting? How much the parent company is getting out of the gain? How much are they getting here?
It's 6,900.
6,900. Then non-controlling interest, non-controlling interest, how much are they getting here? Is equals to the what? They have 20%. So 0.20 times the what? 8,625. How much they are getting here?
$1,725.
Okay. So here, this we are going to add it to this one because that is their gain. So we are going to add that gain into the non-controlling interest here. So this here, I can do here, including it here. So if you add these two here, how much do we get here? So let's put here, not total non-controlling share is equals to 19,000, like you mentioned, 875 plus the amount of the 1,725. So how much the total of the non-controlling here? How much the total of the non-controlling interest here? How much are they getting here?
21,600.
600, 21,600 here. 21,600. Then we are going to put here the gain for the non-controlling interest, their portion. So gain on purchases of business for the parent company. Their share here is what? 6,900. Now if you add your debit here must equal to the credit here. So can somebody add these numbers for us? If you add this, it should be equal to the total, I think, of here. It should be equal to 90. That's why they are saying here, except that everything is the same, which means that you are paying less money to get the company. So the total on the credit side here should be equal to
110,000.
very good. So it's equal to the 110,000. Your debit is equal to why? Because it's it's a gain. Because it's a gain. Because it's a gain. Any questions? I know we didn't do much because I want to take my time because the rest of the chapter is based on everything here. It's based on chapter 3. It's based on chapter 3. That's why I'm wasting my time on chapter 3 here. Any questions as we are bringing the class to an end? Any questions?
No,
Okay.
Professor.
No? Okay, good. So if there's no questions, I'll see.
Professor.
Oh, yeah, go ahead.
So everything was clear until the last 3 minutes where we have to use that information and enter it into the about information. Would you be able to explain it again after
this one's here, right?
Share of the
Here.
gain. Yeah.
Okay. So you know that when we buy the company, right, we have to know, are we paying less money or we are paying more money? Remember chapter 2, that if you pay less money, in other words, if your, let me put it here, if the book value here is equal to the implied value, which means that you pay exactly the amount you want to pay. So first, what is the book? How much the book value? That's the first. All what we did here, the book value, we did the book value here. How much the book value of the company, right? For example, let me start from here. I know my time is up, but guys, just give about 2 minutes. Forget about this for now. Let's forget about here. Now, the book value on the first example here is 80,000, right? Plus the 46,000, plus 21,500. How much the book value here, please? How much the book value here? Can you add it for me? 80,000 plus 46 plus 21,500. How much is that?
156,500.
156,500.
156,500.
This is the book value. Meanwhile, the implied value, right? Implied value here.
I think the answer should be 147,500.
147.
Yes, 147,500.
Okay, so the book value here is 147, right? 500, right?
Correct.
But how much did you pay? Your implied value here, right? The implied value is equal to this amount, 175,500. So you pay more than. In other case, the implied, the book value here is less than the implied value. Does that make sense? It's good?
Yes.
And that is why it created the difference of 28,000 here, because you pay more. There was no gain, right? You pay more than the value of the company. So that's what we have here. Let's look at I'm going back again. Let's look at the exercise 2 or the B part, right? B part also said that the value here, 90%, but we pay 116. So let's look at the book value there. The book value on the B is equal to the what? 90,000, 95,000. So add the number for me. 95 plus 70. So 95,000 here plus the what? 37,500 minus the return and negative minus 14,500 here. So how much the book value here?
118,000.
118 like this.
Yes, Professor.
So this. Okay. Now what is the IV implied value here? How much is the value of the entire company? We take the price 116 divided by you own 90% divided by 90. How much do we have here? How much is that?
It's 128,888.88.
So let's make it 9. So what happened? Your book value here is what? Less than our implied value, which means that you pay more. How much extra money that you paid? And that is what comes in here. You pay extra money of 10,889. Is that okay before I continue? Is good?
Yes, Professor.
Good. Now let's, yes.
You have 116, isn't it 118,000?
Which one? This one is 8.
Yeah.
118 is 118.
The implied value.
No, it's one. You see,
okay,
you
okay.
take the one. Now let's look at the the last one. I like the question you asked. It's very, very good question. So now let's see. Now on the C part, right? We know that in question C, the book value here is equal to the what? The 90,000. So those that calculate, please do as the honor. Plus 20,000 minus the what? 2,000. So how much the book value here? I think that's why you guys said 1008, if I'm not mistaken, right?
Correct.
But what is the implied value here? You paid 79,500 divided by your percentage, which is 0.8. How much the implied value here? And that's what you guys said, 99375, right?
Right.
So what happened? You are paying what? Less. Once you are paying less, it means that there's a gain. That you gain because I pay less money, so I'm gaining. And that's what we said. The gain here is what? 8,625. But this gain, because the parent company don't have 100%, should be split between the what? The parent company and the subsidiary company. The non-controlling company or interest. And that's what we did here. Does that make sense now? It's good?
Yes, that part was good, but then how we above for the part C use that information and we edited the journal entries.
Very good. So in part C, we are editing the journal here because now remember this number here. We know that when it comes to the what? To the gain here, right? Come to the gain here of 8,625. We have to split it between the what? The 80% that go to the parent and 20% that go to the non-control already. Already, the parent company here have an investment already. They invested, their investment in the company here is equal to the what? 79,500 plus their portion of this amount, which is plus this portion, which is the what? 6,900. We said their portion 6,900 here. And that's why we have it here. So you can see we have their gain here and their investment here. The non-controlling interest, remember the 99,000 of the implied value 375, they own what 20%. So how much they are 20% share? Plus they also have to get a what 20% share of the gain here. And we did it, and we said that the 20% of this, I think, was 19,000 or so, 19,000 something. If you guys remember, I can't remember the number, but I think it's a 19,000 and something. If somebody can do it for us, 20% of the 99,375. Yes. Go ahead.
19,875.
19,875. We have to add their gain with the 20% of the gain here. 20% of 8,625. And I think that came up to 1,725. And that is what end us getting this money here. Where is the 20,000? Where is the CC? Yeah, that get this one here, the 21,600. Because they are getting two things. One is the what? Their investment pertaining to the what? Implied value. 20% of the what? The implied value, and also 20% of the gain. It's good now?
Thank you so much for.
You're welcome. Of course, that is my job. If you understand it, that is all what I need. I don't care. You can get A. I can give you the A. I don't have any problem. Once you understand it, that is what I need. Good. So we are going to continue. Thank you. I'll give you a time back. Believe me, I'll give you the time back. So we are going to continue this one. And congratulations to all of you on the test for the excellent work that you did. So we'll continue this one and maybe finish it on Monday.
Can we see the attendance sheet, Professor?
Oh,
Please.
attendance sheet. Because of the time, I'll show you both of them on Monday. Okay?
Okay, thank you.
Yeah,
Have a good
because
night.
of the time. Good night.
Thank
Because
you,
of the
Thank you,
time.
Professor. Have a good night.
You work. Good night. Good night. Good
Thank
night.
you so much. Have a good night.
You good night. Good night. Steve. Coming. Steve, can you hear me, Steve?
Yes.
You know you didn't take the midterm, right?
Yeah, I'm
Huh?
aware.
Oh, you are aware of it, that you didn't take it, right?
Yeah.
Okay. So what are you doing about it?
Is there any way I can make that up?
It's open. It will go up by Saturday. Make sure you do it before Friday.
Oh, yes, of
telling
course.
you.
Okay. I
Okay.
thought it passed for a second.
Yeah,
'Cause I
but if
remember it
it's
still being open.
okay, so you have until Friday to submit it.
Okay.
Okay, bye.
Thank you.
Professor,
Yes.
I'm gonna send an email, but it's like regarding like the questions, like apparently it was like blank, but like
Yes. I
yeah,
think you submitted a blank this thing, right?
yeah, like
Hold
but
on. Let me see. What happened? Yeah, I think so. I think it's you. I think give me
yeah,
1 second.
cause like right now I'm seeing it too, like the file that you like got like was blank, but like I'm pretty sure like I did it and I did it. I have the file, like I can send it to you right now.
Yeah, but why is it? That's why I don't understand why you attach the blank one instead of solving the question.
Like I solved it. Like I sent you the email right now. You can see it, but I did like like I did the work.
Yeah, because I think which one? I think one I will show you the one that you submitted the blank. This one here. I think it was question number 19.
Yeah.
19. You submitted it. Now, you can one of the things is that you can still do because the 2 attempts. You have all the solution there, right?
Yeah.
Okay. Now, this is what I want you to do in order to not to kill the time. Give me 1 minute. I will. The rest is anyone has any questions?
Yes, Professor, I just have one question.
Yes, please.
Did you finish grading the homeworks yet or no?
No. I've not finished
Okay.
it. Don't worry about it.
Okay.
Once you submitted it, you are safe. Don't worry
Okay.
about it.
Thank you, Professor. Have a good night.
You wait. Good night. Good night. Because I want to show you something. Then you do the second attempt. because so that you will not waste time, because I know you have all the solution, right? On
Yeah.
the okay. So give me 1 second here. I want to do something, show you something. Those who don't have any question, let me take them from the class, then I'll show you something. Okay, so let me show you here. Let me stop the recording. I will show you something.